Welcome to our first ever panel discussion on what happens to your UW benefits after life changes. Today, you'll learn about not only what happens to your benefits during these big life changes, but also what your responsibility is when they occur. My name is Jessica Cole. I'm your program manager in the UW Human Resources Benefits Office. Co-hosting this event with me is Barry Nemeth, who is our benefits manager and also works at the UW Human Resources Benefits Office. I have a couple of housekeeping items that I want to go over. We want everyone to know that we're recording this webinar today. I think the message just popped up and let everybody know. We plan to post it on our website, so if you want to watch it again, it will be available. Also tell folks who weren't able to attend today that they'll be able to watch it as well. And it sounds like the whole U will be posting it on YouTube as well. Today, we're meeting with our benefits vendors only. Please keep in mind that if you need any assistance with making changes in Workday due to any of these circumstances that we discuss, the Integrated Service Center is your best resource. As for the format of today's presentation, we have prepared questions for our panelists today. We ask that you remain on mute throughout the presentation. Please feel free to share your questions in the chat feature. We have Anna from the whole U monitoring the chats. Thank you so much, Anna. If time allows, Barry and I will ask questions for our panelists, but we do have a lot of information to go over with you today, so I'm not sure if that we'll be able to get to that. For the questions we aren't able to get to, we will record those and prepare an FAQ to send out to the attendees sometime next week. So do please put your questions in the chat feature for us. And I'll turn it over to Barry Nemeth to introduce our panelists.
Thanks, Jessica. So today we are joined by several of our vendors. We have Katie Dellery from MetLife, who is representing our life insurance and AD&D insurances. We have Kumano Creed, who is representing the Department of Retirement Systems. So that's your PERS, TERS, and LEF retirement plans. We have Doug Stuckey, who is here from Fidelity, and we have Kevin Collins, who is from TIAA. Both of them are representing UWRP and VIP. We are also joined by Jennifer Oswald, who is from the Standard, who is representing our long-term disability plans. With that, I think we're about ready to jump into the first question here. So Jessica, if you'd like to take over and ask away.
Yeah. Hey, a big thank you to all of our panelists for joining us today. We're honored to have you here. And I think I can speak on behalf of all of us attending this meeting. Welcome to the University of Washington. Our first question is, what actions should members take with their benefits to prepare for the unexpected? Let's go ahead and start with Kumano Creed from the Department of Retirement Systems. And you're on mute. It wouldn't be a Zoom meeting if we didn't have someone on mute.
Hi, my name is Kumano Creed. I'm with the Washington State Department of Retirement. I'm a team leader at the Department of Retirement Systems, and I've administered all of our plans. And so I'm hoping to give you some helpful hints on keeping engaged with your benefits today. And in regards to the first question, what actions can you take? Well, I think the theme for me from DRS is to get engaged with your pension benefits. We found that those people that stay engaged, and that could be checking your account once a year, or giving us a call, or just looking at your beneficiaries for updating. If you stay engaged, we found that most people will achieve the retirement goals that they're trying to build towards if they do get engaged. So what I want to do is give you sort of 4 points that you can focus on to be prepared for the unexpected, whatever life event may occur. The first one that we want at Department of Retirement is for you to sign on to your DRS online account access. And so this is a great platform for you to be able to see your retirement account, look at your balance, check your beneficiaries. You can also update them online. And so this is a critical first step in getting engaged with your pension and being prepared for those unexpected events. The second piece is signing up for email and text updates. There's on the home screen of drs.wa.gov to the top right corner, there is an email and text update function, which you can sign up for as a member. And it's a great way to get updates on anything that changes from the legislature or impacts your benefits. So that's another way to sort of stay updated and prepared for the unexpected. And then the third piece is sort of something that I have instructed members over my couple decades, is that even though we're in the internet age, what's really important is to create some sort of central area for information for the loved ones or the family that's supporting you in case these life events happen. And I kind of call it the sort of pension first aid kit. And what I would love you to do is go online to our website and print off the member handbook that's applicable to your pension plan, whether that's left, teachers, or PERS. Print that off. And then also there's an excellent, I'd call it a publication on our website. And you can put it in the search engine called Retirement Planning Checklist. And that checklist gives you a 2-year horizon on how to plan for your retirement. So that's a very good piece to have for also the people that are helping you, the beneficiaries. And so with the member handbook and the retirement planning checklist, and then a printout of the contact information for DRS, I think that will provide the beneficiaries and yourself a way of staying engaged in your pension account, and an area that anybody can go to in case you get hurt on the job and you can't help yourself. They will know where to contact us to get information about those life-changing events. So to me, those are sort of the 3 pieces all wrapped around staying engaged. I would love that you would check your beneficiaries once a year online. That would really help a lot. But signing up, I would love you to do that today if you haven't. And then, of course, checking your beneficiaries, and then signing up for those updates from legislation or anything that occurs on the statewide pension platform, and then creating that little file, that first aid kit that will help beneficiaries. Also, too, you would want to put a copy of your beneficiaries in that file. And I think that's a great way to stay connected to your pension and a great way to explain to others what kind of pension you have. So to me, those are the key pieces. But like I said, those individuals that plan, ask questions, they call us, they get engaged through applying online to look at their account. Those individuals will achieve the goals that they have set in their retirement. So that would be my 2 cents on that question.
Thanks, Kamano. While we're on retirement, Doug, with Fidelity, do you want to go next?
I will, thank you. Yeah, I'm Doug Stuckey with Fidelity Investments, and I'm one of the people that used to be on site that you can meet with to discuss your retirement. Now it's all virtual and by phone, but hopefully I'll be back on site again eventually. You know, I think the biggest thing you could do to be prepared for the unexpected, this isn't really related to retirement necessarily, but just make sure you have an emergency fund. Everyone, if without an emergency fund, you're one emergency away from being neck deep in credit card debt, and you don't want that. So I'd say make sure you have an emergency fund. And then just to echo a lot of things that Kamano said, keep your beneficiaries up to date. I'll be showing you how to do that a little bit later today, how to update your beneficiaries online on the Fidelity website. And then also, maybe think about organizing your finances. So if you've worked at multiple institutions and you have all these accounts outside of here, think about what your heirs might have to go through if something happens to you. I'll never forget, I had someone come in once that had a loved one pass away, and they literally had no idea where anything was. And when they came back several months later, they had discovered there were 8 old retirement plans still in those plans with 8 different institutions. And it was a major headache for those beneficiaries to get those consolidated and dealt with. There weren't even beneficiaries on all the accounts. So, you know, for you, the employee, consider consolidating old retirement plans together. Just get organized, make sure there's beneficiaries on them, and make sure that your beneficiaries are aware of where those are. That's all I have. Thank you.
Great. Thanks, Doug. And while we're on retirement, still, let's head over to Kevin from TIA. Do you want to go next?
Sure. Thanks, Jessica. Doug and Kamano have fabulous advice that I'm only just going to echo the same things. Emergency fund, emergency fund, emergency fund. You need to have it in a cash account. I know I meet with a lot of millennials or even Gen Z people that say, oh, I've got a Robinhood account. No, your brokerage account is not an emergency account. It needs to be a cash account that you can liquidate and you can get cash out of, even if an emergency constitutes fluffy going to the vet. So think about having that emergency fund, 6 months of expenses or your income in that account if you can, and then meet with whomever you feel comfortable with. If you're meeting with your Fidelity rep, if you're meeting with TIAA, if you have an outside advisor, make sure you're leaning on that advisor or that advice, because we are here to help you. I know that Doug and I are part of the benefits package. And so if you do need help with your finances, if you need to figure out, okay, how do I set up my beneficiaries? What are the options that are available to me? Can I take a loan from my retirement plan? I don't know what to do. We're here to help you. You are not alone. And so you can always seek out help. I know during the COVID-19 era, you're thinking, I'm stuck at home, or you guys aren't on campus. We're still here for you virtually through the phone, like Doug mentioned with Fidelity. So don't think that you're high and dry and we've left and abandoned you. We're still here. So even in non-emergencies or during emergencies, please give us a call, set up an appointment.
Great, thanks, Kevin. I like how Kumano brought up printing out materials where people could reference where their accounts were. And I know, Doug, you said there were several accounts for that one example that you were using. Where would UW employees find materials where they could kind of file away information about their retirement account with Fidelity or TIA?
As far as having multiple accounts, that would be hard to do. We have planning tools where you can manually enter in and you can track other accounts. So there's a full view system where you can add other accounts if you want to track it in one place. So if you decide that you want to keep those accounts with other institutions, you can enter that login information into the full view window so that if your heirs can get into that, they could see it all in that spot. Otherwise, the VIP generally accepts outside retirement plans. So as far as consolidation goes, moving other accounts into your voluntary plans so everything's under one employer might just simplify that.
And I'll just say with TIAA, it's called the TIAA 360. So whether you're with Fidelity and using that full view that Doug just mentioned, or if you're with TIAA, it's called the 360, and you can do the same thing, upload your info, and it's all right there behind your login.
Great, thanks. All right, so we're going to go ahead and move on to MetLife. Katie, would you like to speak?
Hi, everybody. My name is Katie Dellery. So this first question, in terms of MetLife, so your life and AD&D insurance, I'd first advise you to assign a beneficiary, which is a common theme in this discussion. But assign the beneficiary to your basic life and basic AD&D coverage. Those coverages are established automatically as an employee from your employer. So it's important that you do designate a beneficiary for those. And then obviously, if you enroll for additional supplemental coverage, do the same. You can use our life insurance calculator to determine how much coverage would be beneficial to you or your dependents if you were to pass away. And it's really a safety net to keep you prepared, pay for bills, mortgage, help your family with any sort of education or costs, funeral costs. So it's a great way to stay prepared. And then we also have additional services like will preparation and travel assistance and funeral planning to help you and your loved ones during difficult times.
Great, thank you, Katie. And finally, Jennifer from the Standard, what advice do you have?
Hey there. Thanks, Jessica. I'm Jennifer Oswald. I'm pleased to be here from the Standard representing your long-term disability insurance coverage. So speaking of preparing for the unexpected, long-term disability insurance is really insurance for your paycheck, if you think about it that way. So in the case of an unexpected illness or injury that prevents you from working, long-term disability insurance will provide a replacement for a portion of your income in the event that you experience a disabling condition. So it's really there to help you with financial obligations that health insurance typically won't cover, like mortgage payments, bills, groceries, other types of household expenses that will continue if you are unable to work. And from my perspective, it's really about ensuring that you are enrolled in an adequate plan for income replacement, and know that through the Standard Insurance, UW employees have access to 2 plans of long-term disability. So there's the basic LTD insurance, which is paid for by your employer and insures 60% of the first $400 of your monthly base pay, which means that the maximum benefit is only going to be $240. So for most people, this won't be enough coverage necessarily. So I would highly recommend, if you're not enrolled already, to enroll in the supplemental long-term disability coverage. That plan insures 60% of your earnings up to $10,000 per month. So that means you have a maximum benefit of $6,000 per month of insurance. So that's what I would recommend, is to ensure that you are enrolled in that higher level of protection.
Great, thanks, Jennifer. So that takes us to our second question. What happens to my benefits if I get a divorce? Let's go ahead and start with Katie from MetLife.
Yeah, so the number one thing to do, again, is going to be making sure you have a beneficiary on file. But if that beneficiary is a spouse and you get divorced, you want to make sure to make the update with MetLife. So give us a call. You can update coverages. If your dependents, if you're adding or removing dependents, it's just a way to make sure that you're not continuing to pay for premiums for coverage that shouldn't exist. So just make sure to keep us in the loop as life events happen. Give us a call. You can update your coverages online on our My Benefits website. And there's a dedicated customer service team with MetLife to help all of the PEB employees.
Now, Katie, I had a follow-up question on that. With a divorce occurring and updating your beneficiary, why does somebody need to update their beneficiary from a divorced spouse? Wouldn't the divorce decree take care of that for them?
It does not. That divorce decree will be documentation and proof for at the time of claim if there isn't coverage. But the reality is you can assign anybody as a beneficiary. So it could be an old partner or spouse, and you could get a divorce and get remarried. And if you don't update your beneficiary, the challenge could come in where you have somebody else assigned as a beneficiary that you no longer want to be a beneficiary for those coverages. So the beneficiary will remain in force until you change it. So we could be 10 years down the road. It's just imperative that you update those beneficiaries as changes occur, update your coverages. And I would encourage you also to go online maybe annually at least and update your beneficiary or view your coverages just to make sure it's in line with what you intend.
Great, thanks so much, Katie. Let's shift over to Jennifer from the Standard.
Great, thank you. So in terms of family needs changing and experiencing life events such as divorce, marriage, not necessarily a direct impact on the long-term disability insurance, but I can say that as your family needs change, you get married, you have additional dependents, I would say just continue to evaluate the need for long-term disability insurance coverage to provide that additional income protection in the event that you become sick or injured and you're not able to work. The insurance really protects your overall financial health, enables you to maintain your financial goals and protect your assets, your savings, ensure that your college savings aren't touched, for example, in the event that you need to go out on disability, provides income replacement in the event that you are prevented from working due to a disability, and just that peace of mind you have that coverage as your family unit changes and grows. So I would just recommend, again, continuing to evaluate the level of coverage you have and recommend enrolling in that supplemental LTD insurance for the highest level of income replacement protection.
Perfect. Thanks, Jennifer. Let's switch over to talking about retirement. Doug from Fidelity, do you want to speak to this question?
Sure. Kind of the same thing with your retirement with respect to your beneficiaries. Make sure those beneficiaries are updated because that is a legal contract. Beneficiaries don't go to probate. So you want to make sure that you have the right people in place on your beneficiaries. The other thing is maybe schedule some time, whether you have an accounts with Fidelity or TIAA, schedule some time either with Fidelity or TIAA or both, just to make sure that you're still on track for retirement, because divorce can have a big impact on your financial situation. It can decrease your retirement if some of it has to get paid out to your ex, or maybe you're just feeling like, hey, I'm on my own now, and you want to make sure that on your own, you're still going to be able to retire successfully. So schedule some time to sit down. We'll help you evaluate it. We'll help you build a plan to make sure that that divorce doesn't completely destroy your retirement plans, so you can still successfully retire when that time comes.
Great. Thanks, Doug. Kevin?
I don't have a whole lot to add other than what Doug and Katie just said. Make sure your Benny is updated. We don't want your money to go to your ex unless you want it to. And then, like Doug mentioned, get that holistic approach to your finances. I know a lot of us plan with our spouse or partner while we're together on retiring together. But if you are, again, relying on their savings or their retirement plan in addition to your own, and they're no longer in the picture, make sure that you update that with us. We could talk to you about how that might implicate you. We can give you a different investment portfolio to help you change things, help give you advice on if you need to save more, all that good stuff. So again, meet with Doug, meet with TIAA, depending on who you want to meet with. We're both great. And I do want to mention, again, we're part of the benefits package. I know I saw some questions in the chat, and people are asking, do we have to pay for this? No, it's part of the benefits package. So you can always meet with Fidelity or TIAA at any time.
Kevin, I do want to follow up with a question because I do know that a lot of us in our 20s and 30s may not want to think about planning for retirement. Is it a good idea to start if you get a divorce when you're 25? What should you do?
You should start thinking about your retirement as soon as possible. So I want all my young people, I'm probably older than some of the young people on this call now, but as soon as you possibly can, when you first get hired at UW, come and meet with us. Help us, we'll help you set up your retirement plan, get you on track. The earlier you start, the better. Whether or not you're buying your first house or you're having your first kid or you're getting married or you're getting divorced, it doesn't matter. We want to meet with you as early as possible, even if that means, hey, you can only put $20 away extra per month or an extra 1%, what have you. That's okay. Let's get you on track. Let's get you saving for your emergency fund. But the earlier you start, the better. I know there's some of you out there that might be a little older of a certain age that are saying, I wish somebody would have told me that 20 years ago, 30 years ago. I'm telling you all this now who are young. Start as soon as you possibly can. Your future self will thank you.
Thanks, Kevin. And then let's move over to DRS. Kamano, would you like to speak to this question?
Get my mute. So as a general rule across the board in these life events, obviously updating your beneficiaries would be a big step forward in making sure that you've covered anything in regards to these events. In my current role as a legal compliance unit team leader, I see divorces on a daily basis. And so I want to focus in on this piece especially because I think the pitfalls, especially in this life event, are extremely dramatic when individuals who experience that event do not reach out to us and our team and sort of pose the question, how does this impact my pension? That is the one thing that I would encourage anybody who goes through any of these events, especially on divorce, to reach out to us immediately and sort of explain the situation and what you think the impact might be to your pension, because we can provide information to you that will help allow you to construct a property division order. We can explain the impacts to your pension depending on which direction you go with your divorce. But the biggest pitfalls we find with divorces that happen and we do not have any information or activity on the account about it is that these individuals will come to retire and they will submit a divorce order to us and we will find that it's not in compliance, which means that it'll delay their retirement. It potentially will incur more legal fees for developing orders to compliance. It really is a huge piece in our management of pensions in regards to divorces. So if this does happen to you, please reach out to us and we'll give you sort of a roadmap on how to navigate your pension and the divorce, and hopefully provide you some information in which you can create a divorce order that will not be non-compliant and will prevent you from retiring on time. So across the board on these events, reach out to us immediately, especially on divorce, because that can really prevent the retirement process from moving forward for some time, depending on the proceedings. Again, beneficiaries update across the board is the best step. But on divorce, please reach out to our legal team so we can help you.
Kumana, I saw a question come up in chat, and this will kind of be in your area and possibly also in Doug and Kevin's area. For somebody who may be participating in the PERS or TERS retirement plan, there is a fixed contribution percentage there. And so in the event of a divorce or a marriage in that case, those individuals are kind of fixed in how much they can contribute to those two PERS or TERS retirement plans. Are there other retirement plans that individuals can participate in at either TIA, Fidelity, or DRS that people may want to be aware of?
Yes. So sorry, I'll just jump in. We have what's called a deferred compensation plan. It's a 457 plan, and it allows you to put in, I believe the max right now for age 50 is around 26,000 a year. If you're under age 50, I believe it's about 19,000 something that you could defer tax-free into that account. So it does have a ceiling, but allows you to put a little bit more in than you would normally do through your defined benefit and PERS, TERS, or LEF.
Yeah, I'll also add in, there's a voluntary investment program that you can invest either with Fidelity or TIAA. I saw a question come through earlier about monitoring your contribution limit to make sure you don't max it out. And I've talked to Barry about this in the past and just want to confirm that UW does turn off your voluntary program when you hit the maximum. So you're not going to over contribute to it. So you don't have to monitor it down to the penny to make sure you max it out. But yeah, you can save additional money through that VIP, and there are similar contribution limits. It gets a little bit more complicated when you're over 50 and you're in the UWRP. So maybe schedule an appointment to talk about that.
That's great. Thank you, Doug. Thank you, Kumana.
I'll add that there's Roth. You can do Roth savings too. So that's really cool. The Roth inside your employer plan, again, you have that higher limit than you do in an IRA. You can do both, but it's higher in your employer plan. And also there's no income limit. So if you've ever been told you can't contribute to a Roth because of your income, you can always contribute to your employer sponsored Roth. And again, meet with Doug, meet with Kumano, meet with myself if you do need more information or you have more questions.
Thank you. Thank you.
Okay, I know that's a big question. Are we ready to move on to the next question? All right. The next question is, what happens if I get injured and I can't work? And I think it's logical to start with Jennifer with the standard.
Thanks, Jessica. So if you experience an injury or illness that prevents you from working, you should report a claim to the standard as soon as you believe that you will be absent from work beyond your long-term disability benefit waiting period. And there's several options for benefit waiting periods that are embedded within the employee paid supplemental long-term disability program currently offered to University of Washington employees. The options are 90, 120, 180, 240, 300, or 360-day benefit waiting period options. If you're only enrolled in the employer paid basic long-term disability insurance program, the benefit waiting period is 90 days. So if you believe that you're going to be out for longer than those periods of time, we would recommend you file a claim with us. And if you're uncertain about whether you're going to be gone for that period of time, we would recommend that you just go ahead and file a claim if there's any sort of uncertainty there, just to, you know, give you some peace of mind. And then it will also allow us time to begin our review of your claim and issue a timely payment if appropriate. So there's three options to file a claim. Telephonically, you can do it over the phone to us. There's a phone number that's on the Washington State Healthcare Authority's website on the LTD benefits page. It's a 1-800 number, and it's 800-368-2860. So you can go ahead and just call that claim into us, and we will reach out to your employer to obtain the information that we need from the representatives at University of Washington, as well as make outreach to your physician to get a physician statement to enable us to move forward with your claim. If you want to file a claim online, you can do that as well. You can go to www.standard.com and click on File a Claim. And there's comprehensive instructions throughout the entire claim submission process once you go out there to complete that online account and complete your employee's statement portion of the claim. And then you can also do it the old-fashioned way, just via paper. Contact your benefits administrator or go to, again, www.standard.com and click on Find a Form to download a long-term disability claims packet, and you can just fill that out on paper and mail it into us if you prefer to do it that way. We do take paper claims as well. So I mentioned there's 3 parts to the claim. So we will obtain information from you either on the web, telephonically, or via that paper claim about why you're unable to work. We'll make outreach to your employer to obtain that information, as well as outreach to your physician to obtain that documentation to enable us to move forward with the claim. So once we get all that required information in, we have a benefits representative and analyst will make contact with you to talk about any additional information that could be necessary to complete the claim process and answer any of your questions. And once the benefit waiting period is served, then payments will be made on a monthly basis and are sent directly to you via mail, or we also have a direct deposit feature as well.
Thanks, Jennifer. I also had a question. With being out of work, some individuals may be concerned about continued retirement contributions. Is there any benefit to filing for an LTD claim that may help continue retirement contributions?
Yes, that's a very good question. We do have also embedded into the long-term disability program retirement supplement benefits that you all may be aware of already. So for folks that are enrolled in receiving benefits under the supplemental LTD insurance plan, we have 2 programs available. One for PERS participants, if you have 5 years of service and participate in a PERS retirement plan, we will pay 1% of the first 10,000 of your pre-disability earnings multiplied by your years of disability up to 30% of your PDE, pre-disability earnings. And then for folks that are enrolled in PERS 2 and 3, we also provide a contribution of 2% of the first $10,000 of pre-disability earnings. And this is a benefit that kicks in after the maximum benefit period under the long-term disability plan has expired and is payable for your lifetime. And then we also have a retirement supplement benefit available to folks that participate in the higher education retirement plans that have 5 years of service. And that is a contribution into for your retirement that makes up 15% of your first $10,000 in pre-disability earnings that is made on your behalf to kind of supplement what is maybe missed if you were to go out on disability in terms of your retirement contributions.
Fantastic, thank you.
All right, well, let's talk life insurance. Katie, would you like to speak to this question from MetLife?
Yes, absolutely. So you could be eligible for continued protection, also known as a waiver of premium claim, if you are injured, disabled, or sick. And that allows you to continue your life insurance coverage without paying for the premiums. So in order to do this, you would call our customer service team as a dedicated head customer service team with MetLife. And the number, I'll just shout it out to you, is 866-548-7139. And that will also be included in a follow-up document too, with some other details. And if you are injured, you could also be eligible to submit a claim for accidental death and dismemberment coverage. So there's a detailed outline of coverage and amounts in your plan summary. And that plan summary is online, the HCA website. It's also on a dedicated PEB website with MetLife, and that information will be sent out later as well.
Great, thanks, Katie. Kamano from DRS.
Yeah, so the way I'll approach this, so what we usually see with injuries, and so there's really two areas for us. There's either on-the-job injuries or there's off-the-job injuries. And so those are sort of dealt with differently in regards to how we approach restoring any lost time on the pension plan. And so what happens usually when somebody incurs an injury is that they typically will be off work for some period of time. Now, hopefully they've banked some leave in sick or annual that allows them to be reported for that period of time they're out, which will retain their service credit with us, because that's usually what they lose with us is service credit, which is a key component to our formula, which is 2% times service credit years times average final salary. And so obviously the more service credit years you have, the better your pension will be. It'll increase higher. So what I would encourage people who have an on-the-job injury, that has to be through L&I, or you have your own insurance, and you get to restore that time, and you get to restore it once you come back to service. You would call us and say, I would like to restore my service credit because I had an injury on the job. And we would reach out to your employer. We would ask for compensation in hours to restore those periods where you lost service credit. And what we would do is we'd create what's called an optional billing. And it's called a temporary duty disability for on the job. We will send that bill to you. And then once you pay that bill, we'll put those contributions back into your account, and we will restore the service credit that you lost. And of course, the employer is billed for their portion, but only once you complete your portion. Now, if you are off the job injury, we consider that an authorized leave of absence while you're out. It's not L&I injury on the job. And it has the same process where you would go on leave. Hopefully you have some leave to be reported so you don't have to restore as much. But once you come back from that leave of absence, you would call us and say that you had an authorized leave of absence, and we would create an authorized leave of absence billing. Again, asking for compensation in hours from the employer to create a billing. Once you pay that, we would restore the time. So again, you can sort of see the pattern where you would want to engage with us as soon as these events happen, because then you can address them quickly. A lot of what I've noticed is that most people don't engage with their pension after they come back from an injury. Of course, they have a lot of things on their mind and they have to get back into their job, but they come to the retirement time and then they have to squeeze all of this stuff in along with applying for retirement and separating from their job. And I would not encourage you to be in that space. And so call us as soon as this event happens. Let us know if it's on the job or let us know if it's off the job, and we'll be able to tell you how the path will go from that point forward. And I think that's about it.
I just want to check a quick point of clarification, Kamano. When we're doing those, the pension calculation, it can be different between the different plans, correct?
Yeah, I know I used the 2%. That's sort of the general because Plan 2 was around forever. But you're correct. On Plan 3, we have the 1% calculation times service credit years times average final salary. But the service credit years is accrued the same as in all the plans. And we use the 5 highest consecutive years of earnings for the average salary like all 3 plans. So only Plan 3 is different, where the multiplier is 1% instead of 2%.
And that's because we have the defined contribution
right.
as half of it.
Which I would encourage individuals in Plan 3 to really get educated about that defined contribution side, because there is some opportunities for annuities there at retirement time that I would encourage you really to look at that have cost of livings built into them. And one of them is called the TAP annuity. So I'll stop there.
Thanks, Kamana, for that point of clarification. At this point, let's shift over to Doug from Fidelity. What happens if I get injured and cannot work with my UWRP or VIP benefit?
Yeah, thanks, Jessica. And I'll be kind of speaking on behalf of Fidelity and TIA, because basically the same thing applies to both places for this. So first of all, this is why both Kevin and I talked about the importance of an emergency fund, is because, as Jennifer mentioned, there are waiting periods before a lot of those payments will begin. And so if you have no income coming in, how are you going to pay your bills? So make sure you have that emergency fund. The other thing is just reach out to Fidelity or TIAA, wherever you have money, to find out about other options available. For example, maybe you can take a loan on your VIP or a hardship withdrawal on the UWRP. Just be aware that there are some, I guess, strings attached to both of those. So you want to know what those strings are, and also to be aware that if you already have a loan when you become disabled, you do still need to pay that loan back. And so we'll need to talk about how to do that to make sure you keep making those payments so you don't default on that loan and cost yourself a bunch of tax and penalty. So just reach out to Fidelity and TIAA, and we will go over the options and some things that are available for you.
Thanks, Doug. Before we shift to the next question, I did want to add just a very quick point. If you are injured and you cannot work, there are provisions in both the UWRP as well as the DRS plans that if you are injured and cannot return to work ever, you are eligible to apply for a disability retirement from the plans. And so if that situation does ever come up with you, please reach out to your benefits consultant in the UW benefits office, and we can get you in contact with the appropriate people.
Great point, Barry. Let's go ahead and move on to our next question. This is more of a heavier question. What happens to my benefits if I, the employee, suddenly pass away? Let's talk with first our life insurance folks, Katie from MetLife.
So in the event that you pass away, your first, the first thing that's going to happen is your coverage and your dependent coverage is going to end. So we want to make sure that that somebody is calling into MetLife and notifying us of your passing so that we can initiate a claim for them and get the beneficiary the documentation that they need in order to submit for payment. And if in the event that you do pass away, your dependents, your spouse or child can continue their coverage for up to 5 months. So they would just want to call our customer service team and initiate that process. And there's also grief counseling services and funeral assistance planning services that are free with your life insurance. And those would be awesome coverages, awesome advantages to have for your beneficiaries or your survivors in the event that you do pass away. So just make sure that they have that information, they have MetLife's number, and they can call us for assistance.
Great. Thanks, Katie. Let's shift over to retirement side. Kevin from TIA.
Sure. So if you do pass away, we want to make sure, and I'm speaking for Fidelity with Doug, he did such a great job on the last question. I hope I live up to his standard. But we want to make sure that you have a beneficiary set up. If you do not have a beneficiary set up, your funds will go through probate, through taxation. It can take years. And then your loved ones will maybe finally receive a benefit in its reduced form after all of that. We don't want that. We want it to go to your loved ones right away. So make sure that either you log into your online account, either with Fidelity or TIAA, and you make sure that it's up to date. Now, if your beneficiary is your spouse or partner, which makes total sense, and both of you pass away, hopefully not, make sure you have contingent beneficiaries signed up. And so if you do pass away, we both, I'm sure Fidelity has a similar service, we have a beneficiary team that will reach out to your beneficiaries and we'll let them know what the services are that are available to them, how they could potentially liquidate the accounts or what type of payment options are available to them, and give them all of that advice and service that they may need. So don't worry about that. What all of you need to worry about is setting up your beneficiaries. It's way easier to do online. It takes about 5 minutes at the most. And that will get you all set up, and then you won't have to worry quite so much about that.
Great, thanks, Kevin. I think I'm going to turn it over to Kumano from DRS.
Yeah, I'd like to kind of follow up on what Kevin had talked about. He made a really good point about contingents. That's one of the big pieces we find that are missing. And of course, in the event that both passed, a spouse and a member, contingents would be critical to our process of dispersing monies to beneficiaries. So contingents are critical, and it's what we don't see enough of. Most people think they put a beneficiary and they're done. Well, you got to have a plan B, and that's a contingent. And so I really encourage you today to look at your account at DRS to make sure you have a contingent. The other piece of it is I'll look at it as non-married and married. So in our pension plans under TERS, LEF, and PERS, there are provisions for members who pass to have survivor benefits for their spouse. And it depends on an amount of years that you have. I think in PERS and TERS, it's about 10 years. If the member has, and if they pass, there would be an option for the spouse to either have a lifetime benefit or a lump sum payout of their account. LEF is a little bit different in regards to the payout of a lump sum, but the survivor would be facing reductions at the time of that passing. So it'd be based on their age. So obviously if the member died young, then, and if the ex-spouse or the spouse is fairly young, the reductions would be pretty big. But you would have an option between a survivor benefit and a lump sum payout. If you're not married, then of course the beneficiaries would be dispersed 100% of the account. If there's no contingents and they both passed, the beneficiary primary and the member, then obviously, like Kevin said, it would go into probate and it would just be elongated process. So please put in contingents.
Thanks, Kamano. And then I think the last person we want to hear from today is Jennifer from the Standard on this question.
So if you pass away and you are not on an LTD claim, then your coverage would end. If you pass away while you are on claim and you are collecting LTD benefits, and you have been continuously disabled for at least 180 days, we do pay a survivor's benefit, which is a lump sum equal to 3 times your monthly long-term disability benefit. And that would go to your surviving spouse or your surviving children if you have them.
Just a follow-up question on that, Jennifer. Do you have to designate a survivor on your LTD benefit?
No, you do not. It is simply paid out per the terms of the contract language, which specifies your surviving spouse or your children if you have them.
Great, thank you. All right, any other points on this question that we want to cover before we move on? Great. Okay, so the next question, what happens to my benefits if one of my beneficiaries passes away? Let's go ahead and start with Doug from Fidelity.
Okay, thank you. So this also applies to TIAA. So as Kamana mentioned, there are kind of 2 levels of beneficiaries. There are primary beneficiaries and contingent beneficiaries. So that's kind of the order of who receives the assets if something happens to you, the account owner dies. So it goes to the primary first, and if the primary isn't there, then it goes to the contingent beneficiaries. So in my case, my spouse is my primary, my kids are my contingent. So if my spouse doesn't get hit by the same beer truck that takes me out, then she'll get it. But if that beer truck takes out both my spouse and me, then my kids get it. So if any of my beneficiaries passes away before I do, then it's important that I go and update those beneficiaries. Might be a couple reasons to do that. So let's say that I'm older and my kids are now married and they have kids of their own. So if I have 3 kids and one of my children predeceases me, that would leave 2 contingent beneficiaries. And then if my wife and I pass away, the money would now go to those 2 beneficiaries that are remaining. And the one that passed away would not continue onto their heirs. So if I wanted that money to go to that child, if I wanted to go to that child's family, like my grandkids or my son-in-law, then I would want to make sure that I update my beneficiaries to include that, so that it doesn't just go to my other two kids, that my other heirs from the child that passed away still get some assets. So if a beneficiary passes, hopefully that doesn't happen. Just make sure you go in and update it. Make sure you understand what's going to happen with the assets. If you have questions about what's going to happen, you can call Fidelity or TIAA and say, hey, if I were to die, where would my money go? Who would get it? And we can look up your beneficiaries and give you some guidance there. Great question.
Thanks,
I have a
Doug.
question.
And we're not taking questions quite at this time. You can put it in the chat feature, and we'll follow up with answering questions. We're going to move over to Kamano from the DRS. Same question. What happens if one of my beneficiaries passes away?
Well, sort of in the discussion we had prior, I believe hopefully you'll have contingents and we would just rely on those contacts for dispersing benefits. But if you do have beneficiaries that pass away, we would hope that you would go online or call us to check on who your beneficiaries are and make any changes at that point. So I think really this question is about just making sure that you stay engaged in your pension plan, and that question would take care of itself. But remember, you must have both levels of beneficiaries to be able to sort of protect you against an event like this, so your pension is protected.
Thanks, Kamano. A bit of a follow-up question. Whenever we're updating our beneficiaries for our DRS pensions, do we do that best via phone, or can we do it online as well?
Well, we require a signature by the member on that beneficiary document. And so you can either sign in online and do it, which is the electronic password and entry is your signature on the approval of that change, or you can print off a form online and mail it in. Unfortunately, we have nothing on a phone process that you can change. We do need your signature.
Perfect. Thanks for that clarification. Next, let's maybe Katie from MetLife.
Yeah, so when your beneficiary passes away, they were your beneficiary probably for a good reason, which means take advantage of our grief counseling services. So those are free services that come with your coverage that will help you get through a difficult time. And then to mirror everybody else's comment, it's crucial to update your beneficiary to make sure that you're considering the fact that you've lost somebody that was set up as a beneficiary, and updating your contingent beneficiary. With MetLife, you can have beneficiaries set up per line of coverage. So if you wanted your spouse to be a beneficiary for one coverage and your child to be for another, or you want to split it up based on percentages, that is allowed, and it can be done online directly and easily, or you can give us a call and we can do it over the phone.
Hi, Katie. I had a quick follow-up. Is there any issue in naming a beneficiary or a contingent beneficiary who's under the age of 18?
You can. You can designate a beneficiary under the age of 18. If you pass away, there is another layer that goes to the person who is the, I can't think of the word.
Guardian.
Thank you, the guardian for that individual. So there is a piece of that, but you can absolutely name that person as a beneficiary.
Okay, so I think I do need to take us to our final question. Thank you so much for that, Katie. I think over the whole panel discussion today, I think there's a general theme of keeping your beneficiaries up to date. So this final question, it may just be saying that again, but what actions do I as the employee need to take in order to keep my benefits up to date? And let's go ahead and start with Kevin from TIA.
Jessica, did you want to say benefits or beneficiaries? Because I can talk about both. Which one?
Let's go ahead and go broad, benefits.
Okay, keeping your benefits up to date. I love that.
Just keep in mind we only have 5 minutes left.
Okay, if you want to keep yourself
so.
up to date, meet with us, meet with Fidelity, meet with TIAA, meet with DRS, meet with the people that are available to you. We can do like a doctor's office annual check-in, make sure you're on track, make sure your beneficiaries are updated, your addresses, all that good stuff. And it's part of your benefits package. You don't have to pay for it. So please meet with us.
Perfect. Nice and concise too. Thanks, Kevin. Doug, do you have anything to add to that?
Yeah, that was sweet and to the point. So I'll do the same thing. I'm going to do a quick screen share to kind of show some of that. So if you can all see this is just a test account for the Net Benefits website. To change your beneficiaries, you just click Profile up here and then Beneficiaries. So pretty simple to change them. So make sure you adjust that. And like Kevin said, also schedule an appointment. Let's just make sure that all of your benefits are on track, that you're saving enough money, that your beneficiary is on file. It's a whole ball of wax. So let's look at it all.
Thanks, Doug. Let's move over to Kamano from DRS.
Yeah, I sort of want to emphasize this last question as sort of gathers everything together that we spoke about today. And I want to loop back to where I started, which really had to do about getting educated, because I think if you keep benefits up to date, it really infers that you have to take some action, not only to just go online and check your beneficiaries, but to also get educated about your plan, because those loved ones around you, if they're educated, that's also part of being up to date with your benefits, because they understand what to do. So if there's anything I'll leave you with today, is to not only get engaged, but to get educated. And if you follow those 3 points I pointed out in the first question, I think you'll be well on your way to having those benefits in a place you want them to be. So thank you.
Thanks, Kamano. Katie from MetLife.
Yeah, so first and foremost, make sure all your demographic information is also updated. So review your benefits and beneficiaries annually at least. Go online, give us a call. Make sure that your demographic information, your address, your name, your dependents are all updated and remain updated, not only with the University of Washington, but also with all of your carriers.
Thanks so much. Okay. Jennifer, I did want to ask really quick before we end, is there anything else that we need to know about our LTD benefit? Are there any extra benefits that we should be aware of through the standard?
I think the only thing to mention is disability waiver of premium. If you do go out on claim, we will waive the premium for your benefits. So you're not paying that while you're out on a disability. It's an important little perk.
Perfect. Thank you so much, Jennifer. Barry, anything you'd like to add before we wrap up here?
No, I'd just like to thank all of our vendors and representatives from joining and giving so much great information to everyone. As Jessica mentioned, we will be collecting all of the questions that came in through the chat and putting together a FAQ for everyone and passing along some great resources that this team will be able to provide for us as well. Thank you all.
Yeah, thanks so much for joining us today. I saw some questions about whether we're recording. We are recording today, and we will be posting this video online. The whole U will have it on their YouTube page, but the Benefits Office will also have it on the Benefits webpage that's hosted on the UW Human Resources webpage group. You'll see that probably early next week. We will also be following up with an email to everyone who registered to send you out some really concise summary of the information that was put out today. I know it was a lot, and then some additional resources that we weren't able to cover today. We all want to thank you for joining us. On behalf of the UW, thank you, Jennifer, thank you, Doug, thank you, Kamano, thank you, Kevin, thank you, Katie. We are really honored to have you here today with us at the UW.
Thank you.
Thank you.
Bye, everyone. Have a great day.